Hello and welcome to this new weekly market analysis video. So this week we're going to talk about Bitcoin. Bitcoin just dipped back under 100k earlier this week, and yeah, I've seen a lot of questions, on social media, people trying to make sense of it. What does that mean? So we're going to talk about that today, right? We're going to see what would need to happen in order to validate one or another scenario. And we're going to cover also the other symbols that, building upon what we started last week. And also take the chance to talk a bit about a side topic, which I really like, is passive portfolio, right? We're going to see how a diversified passive portfolio can help really curb and even thrive when markets get scary. All right, so let's dive in. Analysis of Bitcoin. All right, so another week of decline for Bitcoin right there, the red bar. So if you remember last week, we were saying that we were in a consolidation, right? Bitcoin failed basically to break to the upside on this black line there and started heading towards the downside, right? So this week what I did, I also drew a channel. If we zoom out a little bit, we can see that we have a beautiful upward channel there where price is, steadily making its way up, right? And this is a logarithmic scale as well, right? Just so you know. So if you change it to logarithmic, we have really something very clean. However, the price failed basically to hold at 100,000 around here, which it did last week, and did back lower. Right? So what does that mean, right? Does that mean that that's it? The bull run is over and everything is going to crash? Well, no, not necessarily. At least that's not how I look at it, right? As I said last week, and that's what I'll be pretty much repeating every week, right? The only thing I do is to look at charts and the stories they tell us, right? Once again, here we don't have a break of structure. There is nothing telling us that the narrative of the bull run and the upward momentum of Bitcoin is fading away, right? I mean, if you just look at the previous consolidation and drop, like the one from earlier this year, right? From the peak, we had a 30% drop, right? Here from the peak, we're at 24, right? So, it happened in the past, so there is potentially more room for Bitcoin to just drop, and potentially rebound, right? What it's going to look like, we don't know for sure. But once again, there's a few scenarios that come into play, right? So what really will be important to see is how is Bitcoin going to react around this line that I drew. Again, the channel is not a line like, sacred line that cannot be broken, whatever. The channel here helps us to define the rate at which price is going into a direction, right? And it is really bounded by these two lines. It's steadily going up. Of course, it looks less dramatic on logarithmic scale, but that's what we want to look at, right? So here, we basically failed to break up from there. We are consolidating a bit back down. So, for me, there's nothing that tells us that's it, the party is over. We could very well see the price, bounce back, maybe go back to pivot, consolidate a bit more under that line, and then break to the upside. That's what I'd like to see, right? That would give us a beautiful cup and handle. That's what I want to see. That's what I like to trade as well. So that would, around April, May this year could give us a nice breakout. Of course, it could be sooner as well, right? But to have something really tasty and clean to take a position, I'd love to see that. But this could also take longer, right? We don't know basically where the lower bound is, right? There's a chance that also price goes deeper and retraces back to that level, right? In that case, maybe it's just gonna take longer for the price to do its thing, right? And we have a level right here, which actually, if we zoom out, this is around the previous, right there, the previous all-time high, right? We have a zone right there. So we have a zone around 70k right there. Maybe we have one that is a little bit closer around 75k, literally right 75k. So we will see, right? Either price is going to stabilize around that, going to go back up, oscillate, or it's going to consolidate deeper, right? Whether it's going to be here, I don't know. But I would say up until that line there, that blue limit isn't broken, there's nothing telling us that, that's it, the party is over. So I'm not, perma-bull like they say on Bitcoin, whatever. I'm just reading what the chart is telling me, and based on what has been happening and what I see, yeah, the narrative is still bullish. So let's see what Bitcoin gives us for the next few weeks. But so far, so good, I would say. Analysis of the Ethereum now. So yeah, as you can see, we had another week of decline, a big red candle right there. So that's what we drew last week, right? If you see last week, we had a strong rejection, right, around the $3,000 level, kind of, right? And this week is still holding up, right? We're still like a week of decline, yeah, but like we can see that there is something there that is keeping the price from going down. So here's what I drew last week, right? Last week, exactly what we said. Look, we said that there's a chance that price, just goes back deeper. We have a strong area of support there. There's a chance that price just, dips back around this area. And then, yeah, we might be in a range basically for price to oscillate between this, two bounds there around 4,000 and 3,000. And yeah, maybe we see here the formation of a big bottom, like of a cup. And yeah, what I'd love to see basically is so price dipping down, coming back up, oscillating and reducing these and breaking out to the upside. That would be amazing, right? I would love to see that. We will see. So far, just like we said last week, we are still in a bullish scenario. There is nothing again that tell us that there's no clear break of structure, of support. It's still like holding the line. Analysis of the Ripple XRP. So a week of pause here, right? This is what we drew last week. We were hoping for really like, triangle flag pattern in construction. And well, this week, this is still going on, right? As you can see, we rejected there, like we drew this line. So we have a beautiful reduction in volatility there. Like it's tightening up, right? And well, this week is still part of the same scenario. Let's see now if we can get back a bit to the upside and have a bit more of these oscillations that are tightening, like cooking under the previous ATH. And then what we want to see, I keep saying it, what we want to see is a beautiful, powerful breakout after tightening up. And that would be a really, really good opportunity to take position, right? As a reminder, here we had a huge triangle, right? With a tightening there right at the end, tightening of the volatility, very tight. And then a massive breakout, right? So now we are basically after the first run, we have a consolidation on the previous ATH, right? So yeah, would be very excited to see. Hopefully it would be nice that this takes a bit longer, right? Like, that takes us to May, April next year, that it gives time to really contract and then break a bit like here, right? So we will see, but still, I think bullish bias on the XRP as well, of course. Moving on to gold this time. So look at this, we have a beautiful doji there for gold, right? So a week of pause, we had a huge, comparatively, right? Wait, I'm still in logarithmic, so I'm going to actually scale back on linear. We had a really big drop, right? End of October, and then it basically held on there the past 2 weeks, right? And last week, again, a week of pause, we tried to push up, didn't work out. So nothing again telling us that gold is reversing, right? Like, being in a position here on gold, I'm not selling, right? I'm not selling, I'm following the trend using different techniques based on the rate at which price is going up, right? And here we had a bit of a climax, right? As you can see, the trend was really like steeper and steeper, and here we have a bit of a big drop, but it hasn't dropped that much. And what we might be actually doing is a staircase. We are, if you're familiar with Nicolas Darvas, which use boxes, the Darvas boxes for consolidation, this is what we're doing. We are building a staircase since we extracted from this large base here. Up, we had the first step here, we had another step here, we had one there, another big step there, and two of these were actually excellent opportunities to enter and place a trade. And here we are building another step, right? A bit deeper, but nonetheless, nothing tells us the party is over. So I think the momentum right now is still going on gold. Let's find out in the next few weeks what happens. Right now we are bounded. Probably might see something, maybe something like this, where right now price is a bit stuck. It might stay stuck for a bit. We will see. Analysis of the S&P. Right. Well, look at that. As you can see, we are still in our channel, and look, in blue, this is what we drew last week. So we are still in our bullish scenario, right? As you can see, this is a pause, right? The price tried to have a push to the downside and tried to have a push to the upside, right? And it's a pause. We are contained within the previous week's high and low. Still bullish. We are still in our channels. There's nothing going on. So what we drew last week still stand. We can actually redraw it, but it still stand, right? We might see a reaction for it to resume to the upside, or maybe this is gonna go actually sideways for a little bit longer before breaking up. We don't know, right? Let's we'll find out, but still intact. Analysis of the Nasdaq, same thing on the Nasdaq. I'm gonna try and redraw that a bit better. So a bit more volatile, but as you can see, right, we are holding there. So maybe we're gonna see resumption of trend, or we are gonna go sideways a little bit, a bit like on the S&P, right? We will see, but right now our channel is still intact, right? So nothing much else to add. Analysis of the CAC 40. So look at this. We were saying last week that there were two scenarios at play here. Either we would see the price bouncing off this big resistance line there that it broke and going to the upside, or we may see there was a false breakout and we may see the price basically dipping back under and maybe consolidated for a bit longer, right? Well, this week is showing us that it looks like the first scenario, right? Look at this. We had a beautiful break, pullback, and now it looks like it's going that way. I'm gonna put it with an arrow. It looks like it's heading that way. So we will see if that holds or not. But definitely, I think that this clearly, money management wise, for sure, for the opportunity that I find on the CAC 40 now, I would be on the aggressive kind of mode, right? All the way there, that was a range, right? Definitely wasn't range sideways, more conservative money management, but there, since that break and since it's holding this week as well, aggressive mode. The DAX, well, look at this. The DAX had a beautiful week of pause, another doji. So same scenario here. We have this tight consolidation. Look, it almost touched the upper and the lower line. So same thing there. I'm just gonna move it by one candle. I would love to see the price going back, oscillating, cooking under there, and having a clean break, right? So time will tell. Let's see what happens in the next few weeks. All right, I'm gonna take a pause here, and I'd love to talk a bit about portfolio diversification, right? And this is different from active trading, of course, and taking trades, taking active position in single assets. And here it's more, the way I look at it is more like just a lot more return on your money versus a saving account, right? Of course, risk is subjective, right? You could argue that leaving all of your savings under the same in the same bank account managed by the same bank is also risky, right? What if the bank fails and so on? Happened in the past. I like the idea of passive investment because it's really about taking things into your own hands, right? And in order to do that, I think that understanding at least a little bit what the markets are made of and what diversification means is just really beneficial and gives you that confidence to hold and stick to your strategy as the decades go by, right? So how do we build properly a passive portfolio that can actually protect you when the market gets scary? So let's try and understand a bit how the capital flows first, right? So different assets are driven by different economic forces. So the money basically doesn't move in one direction across all assets at the same time. And that's why combining them smoothes the equity curve. So these forces, they basically rarely line up perfectly, right? And if you combine these assets, it's going to cause them to partially offset one another, right? So when one suffers, another one might hold steady, often hold steady and benefits. So mathematically, right, it compresses drawdowns and it reduces volatility, right, while keeping most of the long-term return potential, right? So the core logic here, there's two things, right? Basically, when money is easy and safe, investors are going to move into risk assets like stocks, like crypto, maybe real estate. And when money gets expensive or dangerous, investors are going to retreat from the risk assets and move into safe assets like bonds, cash, and gold. So expensive money here means high interest rate, and dangerous environment means like a fear of a recession or a crisis. So here we have a simple, money flow map. So when interest rates are low, that means borrowing is cheap, liquidity is high, the money is abundant. Capital investors are going to flow into stocks, crypto, maybe real estate, so more risk assets, right? Because the safe assets are not paying anything, right? Interest rates are low, so government bonds are just not attractive. So investors are hunting for high returns. Then when interest rates are rising, it means that money becomes more expensive. The liquidity is going to drop. So you're going to have the capital flowing to bonds or cash. And why? Because suddenly bonds is paying an attractive yield, right? And cash stop losing value. So the capital is just going to leave the risk assets like stock, crypto. And an investor might basically tell himself, why would I take risks in stocks if I can get a real attractive yield with bonds, right? Guaranteed return with government bonds. But this is one of the biggest driver of market cycles. A third scenario, when fear or panic hits, right? Regardless of interest rate, that might be, recession, there's a war, geopolitical shock. So capital, once again, here is going to flood to safe assets, right? Bonds, cash, and gold, because safety is just way more important than return at that point, right? Massive fear, massive uncertainty. You want to make sure your hard-earned cash or savings are protected. So capital is going to dump basically stocks, crypto. The risk asset just get liquidated first. Safety first. And when the crisis ends and the confidence return, expectations stabilize. The central bank maybe are easing the interest rate as well. Capital is going to rotate back into stocks and crypto, right? So the investors are re-entering the high return risk assets. So that whole thing basically can be summarized in one short line. Low rate and confidence equate risk assets. High rates of fear, safe assets, right? And that's about it. So in a nutshell, this is a very simple explanation of it. Of course, there are way more mechanics, leverages, and things going on. But that's basically why some asset classes move in opposite direction and why diversification works. And that's what interests us as investors, and to build a long-term, multi-decade, long horizon, diversified portfolio. So to illustrate that, I've chosen to show you 4 different portfolio. In dark gray is the SP 500. So this is from 1994. Dark gray is SP 500. In light gray is a classic 60-40 stocks and bond diversification. In green is the all-weather portfolio from Ray Dalio, so even more diversified. And in blue is my preferred allocation, right? The one that I use and that I think is just like really, really good and resilient. So what's very interesting here is you can see the difference in terms of drawdown. So between Jan 1994 and October 2025, you can see that, the simplest investment is just, buy and hold SP 500, but look at the massive drawdown it had, right? It had a minus 50.8% drawdown, right? That's huge. That means at one point, right, your holdings were worth half of their value prior, right? And that might be extremely difficult to hold as an investor, right? The problem, the problem with that is, can you stick to the strategy when things get tough, right? So the best strategy is not going to be the one that delivers the best returns. The best strategy is going to be the one that you're able to stick with when market takes a downturn. That's it, right? So if we diversify a bit, look, just a 60-40 split stocks bond is cutting the drawdown by 20%, right? That's huge, almost half, right? The all-weather is at 26% drawdown at the worst, right? So that's half of the SP 500. And the portfolio that I really, really like is about under 10%. So that's like 5 times less, right? That's huge difference. Look how much smoother the blue line is compared to the SP 500, for example, and the other portfolio, right? So that's what you want. For me, right, if I'm going to invest my money for decades, if I'm planning, to use that for retirement, maybe for children education, to buy properties when I'm old, if I'm planning to, if I'm going to rely on that money, I want that to be a smooth ride, safe, and I want to be able to stick to it, right? So I don't want to be going through roller coasters, right? And I'm willing to sacrifice a little bit of performance to have peace of mind and to actually execute the strategy. Because the worst thing that could happen here is, you're hitting a 50% drawdown on the SP 500 and, you're just afraid. You can see, your past 30 years of savings and investment just dwindling, cut in half, and you sell. And that's the worst thing you can do because you literally realize your losses, right? So I much prefer to, sacrifice a little bit of performance, but still keeping a really good performance. Now if you look at the annual return, right, the SP 500 is at 10.75% since 1994, so that's very strong, right? But the other one are about the same, right? So about 2% less. They're all about the same value, around 8.5%. But look at the drawdown difference, right? The portfolio in blue just has less than 10% drawdown, still keeping 8.34% profit year on year on average. That's still really, really good, right? I think that if you look at the value of $10,000 back in Jan 1994, should you invest nothing else but those $10,000, would equate to 140,000 or something at that point if you look at the chart. So that's what I like, right? That's what I like to do. I think that if you're looking at more aggressive returns, there are other ways to do better, like active trading, swing trading stocks, which I do as well, or having really risk-oriented portfolio. But you're gonna have to allocate most likely a lower percent of your capital as well to that, right? For the reason that I just explained. So if you're interested in learning how to do that, feel free to go on my website, drop your mail. I'm currently building a way to teach that basically, and I will be notifying everybody who dropped the mail whenever it's released. So if you're interested, hit the website, drop your mail, and follow along every week as I release these videos. Alright, and we are going to finish with the dollar index. So if you remember last week, we were talking about a beautiful double bottom and a breakout potential going on, right? And that's what we drew last week, right? We have a potential upside of around 12%. Sorry, let me redraw this. An upside of, around between 9 and 15%, right? So last week we did not know if we were gonna have a break immediately or if we were gonna stay under that resistance a little bit longer. And well, it looks like we have our answer, right? It doesn't seem like we're gonna get our break right away, for sure. So we may see basically a bit of a longer consolidation under this line before break to the upside. So maybe it's going to look like something like that. We will see, but the rationale is the same here, so we will follow along next week. All right, and that's about it. So thank you very much for watching. I'll be seeing you next week. As I mentioned, right, if you're interested in learning how to build a really resilient and performing passive portfolio, feel free to head over my website, drop your mail, and I'll be sharing news as I'm all along as I'm building this. So feel free to do that. See you next week.